Welcome to Jim's Notes. I'm Jim Farish. As we look at today's market, one of the things I wanted to do is just kind of wrap up the week. I've written kind of a lot of stuff throughout the week, but one of the things that I find of interest to me is just some of the neuroses that's going on in the market. And so I thought a video update with the ability to look at some charts would be more helpful for me, just to be able to show you what I'm talking about, and also hopefully helpful to you to kind of give you some benchmarks of things that are going on. So let's start with the S&P 500, and you can see, the market really has just remained in this trading range, for lack of better terminology, but of late it's just kind of taken on this personality that, whatever way the wind blows, the market's going to move, and which is a total lack of clarity, both from a earnings standpoint and a global economic standpoint and a domestic economic standpoint. And then if you throw in some of the characteristics relative to the Fed and what's going on there, Washington, D.C. isn't helping, but a lot of issues on the table that are causing just really, for lack of better terminology, just total uncertainty about market direction. So despite what I read, listen to, hear, some people seem to have it all figured out and know exactly where this market's going, and they have conviction about it. But in reality, I'm not sure where they get the conviction, other than that I guess they're a talking head and they need to have some. But for me, the market is still in this decision point. It's trying to make up its mind. Putting in perspective, the economic data that we've seen for April so far actually has improved. Outside of a couple of data points, we really have seen an overall improvement in the April numbers. Now, don't get me wrong, it hasn't been stellar, but it's been better nonetheless, and that's something a positive that we could take away from that. On the opposite side of that, we've seen the jobs become an issue with the weekly jobless claims have been, creeping higher. And then the jobs report the last 2 months has not been good at all. ADP numbers that came out a couple days ago were not good. And then I think going into tomorrow's jobs report, you really have to wonder what that's going to look like. And so for one thing, I think if you look at that, at least from a micro perspective, that if we have a bad jobs report, that could be positive for the markets from the standpoint that it would keep the Fed engaged, at least at this point, to hold interest rates at zero. So I think that's something that's all there. So when you boil it all down, the market's still looking for that catalyst that is sustainable on the upside, but it's also equally looking for a sustainable catalyst on the downside, because I don't think you've seen anything so dramatically negative, other than to listen to people talk, that this market is ready to sell off in a large way. I think the market is, as Yellen was so eloquently pointing out in the media yesterday, that the market is pricey. I didn't realize she was a stock analyst, or that was part of her qualifications relative to the Fed chairmanship, but evidently it is. And she's not uncommon in that. We've seen it for Bernanke when Greenspan started it all with irrational exuberance. But the markets reacted to that, and today the markets bounced back slightly. But, some of that is anticipation that things are getting better. Some of it was Alibaba's data on earnings were better than expected, and the stock was up 10 or 12%. So things all across the board seem to be a little bit more positive. Oil was down 3.2%, or about $2 a barrel, back around $59 a barrel, back below the $60 level. And so all of those things said, the market had somewhat of a positive day. But how do we put all of this in perspective? If we look at the S&P, you can see it remains well within its range. If we look at the NASDAQ 100, you can see that it's well within its range. It's pulled back, tested, hovering there around the 50-day moving average. And then if you look at IWM, which is a small caps, you can see that it's pulled back into a support level after selling back here the last few days. If we look at semiconductors, they're hanging on to that 9250-ish support level on SOXX. And, so the leadership of the market is kind of hanging on by its fingernails. and it's waiting for whatever data point is going to allow it to have some believability on the upside, and that's really kind of the view that I have right now. Around the market is a lot of noise, and it's coming from components like oil. If we look at OIL, which you can see broke above this resistance point yesterday, or 3 days ago, and moved up nicely. And then intraday yesterday, if we look at the 5-minute chart, you can see that intraday yesterday, the market for oil started higher, and then it just moved a little bit lower off of that, and that was a continuation on the downside today. So that's a significant move lower for oil, which I think is something that we also have to look at as we go forward, because here's my challenge with oil prices. I think we talked about that it's set up as trades, and it did actually trade out pretty nicely off of a couple of bottoming situations here and pattern trades. But if you look at the fundamentals of oil, as far as deliverable oil right now, supply is very heavy. And because that supply is very heavy, we're speculating that because Europe is improving and supposedly China was improving and supposedly the U.S. is improving economically, that oil consumption would start to come back. We haven't seen that in the true front month consumption of oil, which means that supply is still very high. So the speculation that's in oil is very high. And today you saw some money taken off of the table off the Iran issue, which talk in the media today about Iran supply coming back online. That creates worry. So oil is another worry spot that hasn't really gone away. It had a little bit of a reprieve, and that loops back to the energy stocks, which you can see 80.50 on XLE was our support. We closed at 80.44. If that doesn't recapture that level, I think that's a big negative for energy, at least looking into tomorrow and beyond, is that we definitely want to look at whether or not energy is going to pick up the upside, or the downside, and that oil would track along with that to some degree. So you may see a test or pullback of what momentum we've had in the energy sector of late, and we may see that actually test a little bit, and we'll see how that unfolds. But I think that's definitely one thing that we need to throw on the table as a concern. One of the other sectors that we're looking at right now that's a concern is telecom, which you can see IYZ has come all the way back down around the 2970-ish level of support, and it's also brought into play the trend line, which you can see down here, which is the trend line off of the October lows. And if we stretch that out, you can see that that would start to come in play right there around the 2930 level. That would be a negative, at least from my perspective, near term. So that's something that we continue to look at as well. And then, akin to the oil space has been basic materials pulling back, got a nice bounce today. The industrial stocks have tested back. But you're not seeing across the board any significant changes. If anything, we just continue to see what we're seeing in this chart. We just continue to see pattern setups of consolidation, and you can see that consolidation there, and then eventually it's either going to break up or it's going to break down. The previous trend for XLI off the October lows, we kind of wandered out of it. We didn't break lower as much as we wandered away. I think the 200-day moving average comes into play. If that breaks below that, that would be a negative sign for the industrials. But you can see things are starting to set up with some of these on the downside. Again, utilities testing its bottom of its consolidation lows. And that's something to look at as well. Healthcare testing the support there, as you can see, around 71.25. You've got a lot of sectors that are setting up in and around their support lines. You can see with the retail space, consumer discretionary, down around the 75 level of support, and then we have another support level down around 74.20. But you can see all of them are still well within these ranges. Nothing breaking to the upside, nothing really breaking to the downside within the indexes themselves. And everybody's it's like the proverbial waiting for the other shoe to drop syndrome that the market has taken on at this point. So it leaves us really in a position of more wait and see. Put your stops in place on positions that you hold. Don't overly speculate where you think things are going. Let the market unfold and let things fold out relative to where they are. And that could be economically, it could be, economic from the earnings standpoint, the fundamentals, and it also could be technically that we see things move in a direction that is helpful. And as we run our scans and we look at all the pieces that make this up, you can see things like China, which had been moving higher. You can see the test of support there. And if it breaks below the support level right in here around the 48.90-ish level, you can see that gap left there, and that potentially would fill and come back around the 46.60 level. But, with the acceleration, it has given up some of that upside momentum, and that's something, again, that we want to look at. We've seen the same thing in the emerging markets, and we saw today with that breaking down through support there at 42.40. We close below that level. We get confirmation tomorrow. That really sets up on the short side for EEM, and that's something, again, that as you look at going forward, some validation of these negatives could add up to the market moving lower, and that's something that we would continue to look at. You look at Europe, you're seeing a test back into these support levels around 45.50 on IEV. If we look at the EFI index, you can see the tests are coming back here, support around 65.75. But across the board, it doesn't seem to matter where we look. We're seeing testing, and we're seeing some negatives as well as some slight positives within the markets. Where the big catastrophe, at least from my view, has been is in the Treasury bonds. And you can see we talked about this breaking 129.20 support on TLT as a negative. We felt that this bar right here on 428 was a big negative, and it should have taken you out of positions right in that 127.50-ish level. And you can see that it's sold off. A little bit of a bounce today. We'll watch as that goes forward as well. But a big sell-off in Treasury bonds. If we go back to the highs here in the January-February timeline, you can see that the sell-off in Treasuries has been 12.8%. That's been pretty significant. And even off of the previous high in here, you can see that the downside has been 9.2% off of that high just back here on March the 24th. So you're seeing a transition in bond yields, and that's worry about the Fed, plain and simple. And so you're not seeing money rotate into safety as much as you're seeing it rotate into cash at this point. I wrote a piece about that earlier in the week. So watch how this unfolds, especially going into the last trading day of the week, tomorrow being Friday. But Treasuries have not been pretty, but it's been more than that. You can see BND, which is the total bond market, and you can see just in the last couple of weeks that we've seen, an erosion within this of better than 2%. So we continue to look at that. If you look at LQD, which is the corporates, and if you look at MUB, which are the muni bonds, PFF, which sold off pretty big yesterday, which is the preferred stock. So anything that's interest-sensitive utilities sold off this week as well after a rally back up around 45. We sold all the way back down to 43.30. So you've seen interest-sensitive issues are getting dinged on and pinged on. AMLP, which is the Master Limited Partnerships, which is around oil. So you got a double whammy happening here, a little bit, one with yield, two is with a little bit of price fluctuation relative to crude oil on the downside. And so you have to kind of look at each of these. REM, which is the mortgage REITs, you can see the negative reaction there relative to interest rates. So interest rates are on the table right now. I'm not a believer that the Fed's going to do anything as soon as June or August. I think it's going to be further into the year. If this year, if the jobs numbers tomorrow don't add up, you could see that as well. Will we see a rally back in the yields? That's going to be, an interesting question, at least from my perspective, is that you've seen this bump all the way back to around the 3% level on the 30-year Treasury, a little bit of give back today. But that's a concern, is that whether or not yields will hold steady, or if we feel like the Fed isn't going to hike rates, do yields come back and bonds rally? So those things are on the table. If we look at TNX, which is the actual 10-year Treasury yield, you can see the fade there back to the 218 level, and right around the 200-day moving average. But are yields going to run away? I mean, I've seen pieces about that we're going to see the 30-year Treasury at 4% and the 10-year back over 3%. I think the jury's still out on that. The Fed is going to have a big say-so in that, and so are the inflation data points. So we're obviously, as we go forward over the next week to 10 days, when we start to see the CPI and PPI numbers for inflation, that's going to play into it as well. So a lot of things on the table for you to consider. I think the most important part is you put your stops in place, you manage the risk, and you just keep going forward. You look for the opportunities that are there. But, right now, cash is not bothering me at all. As I get stopped out of positions, I'm in no hurry to deploy that cash, and I'm willing to kind of sit back and let this unfold, because right now it's kind of a guessing game on which side, at least from a microcosm view of the market. Longer-term outlooks, the trends are still to the upside, and I think you got to respect those uptrends as long as they are in place. The short-term trends off the October lows of last year, which are now 6.5, 7 months old, those short-term trends are starting to be challenged. So if that starts to break down, that will change a little bit of my perspective as we go forward. But until that transpires, we kind of got to go with what brought us to the dance. Your trading positions, I'm not trading very much these days, trading 0 to 13 weeks. Time horizons, short-term positions, we're managing the risk relative to the trend lines. And the rest of this just has to unfold. We just have to kind of figure out all the pieces as the cards are dealt, instead of speculating that I think things are great or that things are awful. I think right now things are in limbo, and we're all playing tug-of-war trying to figure out which exactly way this is going to go. So with that, have a great evening, and we'll see you soon.